Thank you, Mr. Chairman.
Senator Hagerty of Tennessee is recognized.
Thank you, Chairman Brown. Chairman Powell, one of the many downsides of quantitative easing is the fact that the Federal Reserve, and then by extension the American taxpayer, is essentially taking a long position in the securities that are acquired. And that means that when rates rise, the value of the securities on your balance sheet drop. That's exactly what's happening today. And as of March of this year, the Federal Reserve had about $330 billion worth of unrealized loss on its balance sheet. That number is probably close to $500 billion right now, given the rise in rates. So my question of you is, do these unrealized losses limit the Federal Reserve's ability to execute its monetary policy objectives? And specifically, will the Fed sell mortgage-backed securities and realize a loss? Or will the Fed be cornered into holding these securities until they appreciate?
So those kind of unrealized losses play no role in our decision-making, have no effect at all on our ability to conduct monetary policy. They're just not a consideration. And they won't be a consideration when we decide whether to sell and in what quantity MBS. We said we would look at selling MBS when the normalization process for the balance sheet was well underway. And that means not soon. We haven't decided exactly what that means. When we make that decision, and the reason, by the way, the reason we want to do that is we're committed to having a mostly Treasury balance sheet. And with these higher rates, MBS prepayment speeds have gone way down. And so to achieve the mostly Treasury balance sheet, we may well need to sell MBS at some future date. When we turn to that, we're going to be very transparent and give lots of transparency, obviously, but we won't be thinking about the balance sheet. I mean, remember that we've contributed $1 trillion in profits to the Treasury over the course of the last 10 years. The reason we don't have a lot of capital is that we give our earnings to the Treasury every year. So it's not at all a concern for us.
But to be clear, these long-dated mortgage-backed securities may be sold as a loss. You're not limiting your ability to do that, to sell at a loss.
No.
And that could happen. I just think that the downside of quantitative easing is very much illustrated for us when you find yourself in this situation of holding these long-dated securities. To turn to another point, Chairman Powell, I realize there are a number of factors that play a role in the historic inflation that we're experiencing. Supply chain disruptions, regulations that constrain supply. We've got rising inflation expectations and excessive fiscal spending. But the problem hasn't sprung out of nowhere. And in January of 2021, inflation was at 1.4%. By December of 2021, it had risen to 7%, a five-fold increase. Now, since the war in Ukraine began in late February, the rate of inflation has risen incrementally, another 1.6%, to a current level of 8.6%. So again, from 7% to 8.6%. Given how inflation has escalated over the past 18 months, would you say that the war in Ukraine is the primary driver of inflation in America?
No, inflation was high before, certainly before the war in Ukraine broke out.
I'm glad to hear you say that. The Biden administration seems to be intent on deflecting blame, and as recently as just this past Sunday, spread the misinformation that Putin's invasion of Ukraine is the, quote, biggest single driver of inflation. I'm glad you agree with me that that is not the truth. I'd like to turn to the situation we find ourselves in now, tightening. A recent survey of global CEOs showed that more than 60% of executives expect a recession in the next 18 months. Meanwhile, per its most recent forecast, the Fed will be tightening monetary policy for the next 2.5 years. Thus, the Fed could soon find itself in the challenging position of potentially exacerbating an economic downturn in order to address the historic inflation that's been unleashed by the Biden administration. So, Mr. Chairman, as you know, the Fed has a dual mandate, stable prices and maximum employment. As we look to the fall, how do you think about balancing this potential tension between the Fed's two mandates, particularly if the economic outlook worsens, but inflation remains elevated?
So we do have a dual mandate, as you point out. Right now, the labor market is extremely tight and I would say unsustainably hot. There's a mismatch between supply and demand there. As you know, there's more job openings than there are, by a factor of 2 to 1, than there are unemployed people looking for work. On the inflation side, we're very far from our target. So we think that we have to restore price stability to put the economy back in a place where in the medium and longer term we can have a sustained period of what we would call maximum employment. So that's how we're thinking about it. Of course, we're not trying to provoke and don't think that we will need to provoke a recession, But we do think it's absolutely essential that we restore price stability, really for the benefit of the labor market as much as anything else.
I agree. I think you have an extremely challenging job,